Well, this end of 2015, obviously an interesting year for the S&P and the Dow and global markets in general. And Bob and I wanted to kind of share some thoughts about what we've been through and kind of where we're headed. Clearly this is the classic theme, the S&P and the Dow after 33 dips. If you bought those dips in 2015, you didn't get much return as you might have in 2014 or prior years.
In fact, if you bought the dips in prior years, you almost always would do well.
Always did well. That strategy isn't working when the Fed isn't supporting the markets like they did in the prior years. And to us, that thesis hasn't changed. The Fed stopped printing money in October of 2014, and if you did the math from October 2014 till the end of this fiscal year, you lost money in the S&P and the Dow. So market didn't have the support of the great manipulator, the great Fed. And in addition to not having the quantitative easing, at the very tail end of the year, the Fed finally raised rates 25 basis points. So in addition to not pumping in money, they slowly and minusculely tightened the money supply or tightened the interest rate. And so, that also had an impact on the return of the market. So without that support from the central government or the central bank, you don't see a robust S&P or a Dow. The other thing I think that's interesting to note about the S&P in particular are the big names like Facebook and Amazon and Netflix and Google that have massive, massive market cap increases in 2015, reminded me a lot of Microsoft and Dell and Cisco in 2000 during the dot-com era. Companies that, as we've talked about, are still good companies, but were massively overvalued then and kind of came back to earth. Amazon, I last read, is traded a 985 PE, so huge, huge multiples there.
And they are driving the market. Without the top 10 players in the S&P, the market would be down. I think the S&P down almost 10% or more. So not only are you seeing that issue, but you're also seeing a lot of earnings issues in general. So earnings, as you were saying, go ahead.
Yeah, I think in the last 12 months, earnings are actually down from last year 15%. So you've got earnings depression, you've got massively inflated FANGs, the Facebook, Amazon, Netflix, and Google, kind of holding the S&P up, but really kind of depressing earnings. In addition to that kind of headwind, of depressed earnings, you also really have these massive sovereign wealth funds coming out of Norway or Saudi Arabia that are typically making bids on the market, in other words, buying. I think this year you're going to see a lot more offerings. These countries and these sovereign wealth funds need money. They're going to be selling a lot of their stocks and bonds and real estate holdings to get some money. More pressure, I think, negative in 2016, which I think, Bob, we talked about, you've written the aftershock. We've been watching these markets since the support in 2008. I feel like we're getting closer and closer now to that, not aftershock, but that trend correction seriously down until the Fed will have to print again.
What you're going to is, we've said all along that without Fed money printing, the market's going down. And it did, but not by much this year. And frankly, it could have been a toss of the coin at the end of the year, whether it was up or down. What we're really doing is waiting for when it goes down. And I think that time is coming nearer rather than later. And I just see that because animal spirits did not rally at the end of the year to push it into positive territory. That was bad. We obviously kicked off the new year with a thud. Could have been the worst opening in 85 years. But we had an end of day rally that made it only a terrible opening rather than a god-awful one. So I think you've lost some of that spirit, partly for the earnings reasons, partly it just takes a while and people move out of the old bubble mentality. But you're right, they're big headwinds. The sovereign wealth funds are certainly not buying and will be selling. I think the corporate buybacks will continue pretty strongly. That's going to be a help. But in January, usually about 5% of your corporate buybacks are done. So January's been a slow month. That's part of the reason. So, I'm ready to say we're at a point here where I think you're definitely looking at a much more likely down market than an up market. Never can say for sure, but I think there's no question going ahead that what we've seen in the last few weeks and certainly the last year tells me that the change is coming relatively soon. I don't think it's going to be this summer. I think we could easily see some problems in January, February.
Yeah, as we're already seeing it in the first week of the market. I think it bears repeating. It's worth sticking to our knitting and keeping it simple. These things we've talked about over and over. When the Fed isn't printing money, when they're actually raising rates and they're not supporting the markets, these markets, which have been in massive bubbles, are not going to behave as they've done in the last 8 years.
Right.
And so we can expect, especially as we're raising rates and not printing, this market to dwindle. And I think that's what we're seeing.
And in general, I think the takeaway from that, final thing, is that anything you look at historically, it generally is not going to be a good guide because we are in such a different era of this massive dependence on the Fed. And I think people see that. I'll use an analogy. It's kind of like if you're going down a runway and you're trying to take off and you're going faster and faster and faster. If you don't take off, people start to realize you're in for a big problem. And I think that's kind of where we're heading in 2016 and 2017.
Yeah. Good point. One of the other topics we want to talk about as we start the 2016 market year, as we know, we literally came to work, and on the way in on the radio and the futures market the day before, China was already in circuit breaker mode in a crash, 7.5% circuit breaker. They probably need a bigger circuit breaker than 7.5%. Clearly, the engine of global growth that is China for the last 6-7 years isn't going to last forever. And the transparency behind what really is real growth and what's kind of paid for growth, and those 65 million empty apartments and train stations to nowhere, it isn't just hyperbole. There are some realities of the fact that if you build it doesn't always mean it will come. And China is a classic example of a massive kind of punch bowl market, a lot of great things happening in real estate and markets, and then suddenly it stops. And when it stops, it affects a lot of things. Clearly, all that debt that China's been taking in the last 7 or 8 years, all that infrastructure building, all of the CapEx and all of that, market movement has ramifications. And when China slows down, the world slows down as well. There's a lot of interaction there. Where we see that playing out is in a lot of places. The kind of interaction between what's happening in China and their monetary policies there, printing and debt. Same thing we did in the US, printing, debt, low rates. All that printed money, all that easy money on the ZIRP policy of the Fed meant a lot of publicly traded companies or a lot of PE companies, or even private companies were taking a lot of loans and doing a huge amount of CapEx investments in commodities. And so the commodity discussion is worth also tying into China and also in the US. It's not just about commodities, it's about easy money. When you have easy money, you invest usually poorly for a long period of time, and you overinvest. Whether it's bauxite, coal, zinc, iron, copper, and of course, oil. You see a frenzy. And with that frenzy comes a lot of fun until the frenzy's over. And we're seeing that in oil. I want to get some of your thoughts on oil because it's not just a commodity play, it's an aftershock play. This easy debt, this easy money, this easy credit has led to a bubble in oil. We've got massive amounts of oversupply, whether you're looking in Saudi Arabia, the US, the Middle East, Iran, everywhere. By every count here, our inventories are at all-time highs, whether it's Cushing, Pad 1, Pad 2, Pad 3. Massive amounts of inventory, probably hitting to the point where we're going to hit oversupply in terms of inventories. We're going to hit storage limits, and then oil will probably go down even more. So oil is a symptom of the same things we've written about and talked about and you've written about. Tell me more about the oil opportunity as it ties into the fact that there's oversupply here, and then with China slowing down, that demand is missing and the supply is over exuberance. That's a perfect storm for the price of oil.
Well, let's start with China, and of course the stock market fell so much the first day that, as Matt said, hit the circuit breaker. Let's be blunt, that means they had to shut the markets down. That's a big deal. I mean, they shut them down for the rest of the day. But the problem wasn't so much the markets. They're volatile. Let's face it, Chinese market has been volatile all last year, and actually it was one of the best performing markets of the year. So volatility itself doesn't bother me as much with China, but the reason it went down was not just typical volatility, but very bad news on their manufacturing. Not just news that had come out from China on their manufacturing indexes, but also South Korea, which has actually seen declines in exports. They're one of China's biggest trading partners. They've seen declines in exports every month this year. So you're seeing a lot of slowdown issues, and that is leading to, as you said, the whole global issue of oversupply. Cheap money is definitely part of the reason we have the oversupply. In fact, they said miners had often had a hard time raising money to expand their mines, and then as the money got cheap, especially the last few years, miners went wild. They were buying companies, they were expanding mines. It was phenomenal. They loved it. You know, kids in candy shops. Oil the same way. They all thought China keep growing. It's a great super cycle. It didn't. And partly because, you know, frankly, since 2008, as you say, most of China's growth has been from, you know, debt, and not so much earlier, where it was more based on productivity improvements, which they had a lot of. And those will remain. But the debt bubble is not, and it's going to pop, and it is popping, I think much faster than China says, as we all agree. And in particular, I think it does lead to a great opportunity in oil, because the bottom line is that oil doesn't cut off immediately, and I mean oil on the short side. I love the oil industry, but I think the short side is still there. Oil hasn't hit bottom, simply because oil production doesn't cut off very quickly. Oil drilling cuts down a lot. We've cut drilling 60-70% in the U.S. Only about 15% around the world, though. Around the world, they're still drilling. We're cutting it back. But nobody shuts off oil wells, nobody, just because you've had a problem or prices go down. And in fact, Matt was asking, well, if companies go bankrupt, don't they shut off oil wells? No, they don't. Not even then, because it still makes sense to keep producing all this oil. You know, costs electricity, truck to send out to pick up the oil. It still makes lots of economic sense, but it makes no sense to drill. And we'll see ultimately oil production going down, but it takes a while. Iran's coming online. That in itself could be 1 million barrels extra this year. We'll see. But the bottom line is, as you said, storage is filling up. I don't think we're anywhere near the end of the oil issue. Even Goldman Sachs, relatively conservative banker, or let's say mainstream banker, says that if we had storage, which is quite possible, storage limits, we'll see $20 a barrel. And I think it can even go below that. Quick reminder, when we hit our production, well, when we hit the 1981 bust in oil, which I remember pretty well, and we cut drilling by 50%, by 1884, our production was actually up in the U.S. Didn't go down at all, despite that massive cut of drilling. So something to keep in mind, production takes a while to go down, demand can go down much quicker, as I think we're seeing in China, and that's kind of the bottom line problem. And creates a lot of opportunities both on the oil side, and I still think mining's got a ways to go too.
Yeah.
So should be an interesting year in those areas.
Yeah, no, and just to kind of recap, keep it simple. Always keep it simple, whether they're talking about stocks or bonds, or they're talking about commodity trades or mining trades. It really does come down to supply and demand, and it comes down to the fundamentals, which have been so distorted by central bank policies and easy debt.
Not just in the U.S., but
not just
China.
in the US, but everywhere. And behind every crisis is a debt crisis and easy money. What we have here in the commodity of oil in particular is a classic case of massive oversupply and a lack of demand. And that might be some bumpy moments in that trade here and there, but the trend is clearly down, and there's no way that demand is going to suddenly increase in the next couple of years with the headwinds we're facing in the world, and the supply just keeps on pumping. No pun intended, so that's oil.
There you go. Thanks.